Welcome to Financial Pearls of Wisdom with Erin Ardleigh. In each episode, an expert will share a pearl of wisdom from their industry. This podcast will provide a deep dive on important topics in personal finance that even savvy consumers and industry professionals may not know. You can find the show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, and Spotify. Now here's the host of Financial Pearls of Wisdom, Erin Ardleigh.
Thank you for listening. I'm excited to share another podcast. So after running an insurance business for the last 20 years in New York City, I've had the opportunity to meet some amazing professionals, and I started this podcast to share their expertise with you. So each episode, I'm going to invite a different expert to come and to share some wisdom from their area impacting personal finance. And today, my guest is Lea Paine Highet. She's a principal at Douglass Winthrop Advisors, a wealth management firm with offices in New York, Washington, D.C., and Florida. She's a CFP professional. And today we're going to talk about how to better understand your personal finances. So welcome, Lea. Thanks for being my guest.
Thank you, Erin, so much for having me. I'm delighted to be here.
So I know if I were to ask my listeners, what brand of jeans do you have in your closet? Or what kind of car do you drive? Listeners, I think you'd be able to answer those questions, even the guys probably. However, if I were to ask, what's in your financial portfolio or what stocks do you own? I'm not sure that everyone would be able to answer that question. So today, if that person is you, you're going to enjoy this episode because we're going to talk about personal finance and how you can better understand what it is that you own. So Lea, tell me a little bit about yourself and what you do at Douglass Winthrop Advisors.
Thanks so much, Erin. So I run the wealth management team at Douglass Winthrop Advisors. We manage about $6 billion for individuals, families, and trusts, and some endowments and foundations as well. But the majority of our client base is a client base that pays taxes. So we're focused on providing great after-tax returns for our clients across the spectrum. As you said, we're headquartered in New York with offices in Washington, D.C. and West Palm Beach, Florida. And our firm's approach to investing, I should say, there's lots of different ways to invest out there. Some of us might say there's almost too many because it's hard to figure out what's the right fit for a particular person or family or trust or institution. So just to tell you a little bit about how we invest at Douglass Winthrop, we invest in high quality individual stocks and bonds, concentrating our portfolio into 30 great high quality businesses that we research here internally and that all of our clients own. And we charge a simple, fair fee, in our opinion, of 1% of assets under management, which keeps our interests aligned with our clients. Many of the stocks that we own are household names that you would know, which has the added advantage, as you were saying earlier, when, do you know what kind of jeans you wear? Do you know what kind of dishwashing detergent you use? It's pretty easy for our clients to answer that key question of what do you own? And we're big believers that being able to answer that question is really important if you're going to have a dialogue with your advisor. But as we referenced, there's lots of different ways to manage money, and many of them are good ways, and everyone has to find the way that works for them. When you talk about what do I own, I think it's important for us to understand what some of the other models look like and why it can sometimes be hard to answer that question. Sure. So in today's world, many firms use what I would call an outsourced model. The investment advisor is retained to provide advice and to assist a client in investing their assets. Many advisors will charge a fee to provide that advice, but they actually won't necessarily invest the money themselves. They will invest the money through the use of sub-advisors. For example, they might decide that they want fixed income exposure or small cap exposure or large cap exposure in a portfolio, and they will allocate funds out to a small cap manager, a fixed income manager, a large cap manager to achieve the goals of the portfolio that they've discussed with their client. And there can be great reasons for doing that. A firm may not have that expertise in-house, and they may have identified excellent managers to do that. But it does make it really hard for a client to answer that key question of what do I own? Because you can imagine if you're invested across 3, 4, sometimes 5 or 6 different sub-managers, and each one of those sub-managers owns a number of individual securities, whether they're bonds or stocks or perhaps funds, you can rapidly, as the end client, end up owning hundreds of different securities. And it's hard to know what those hundreds of different securities are. Conversely, funnily enough, over the last couple of years, we've seen an interesting phenomenon, which is many sub-managers in chasing the performance of, we've all heard of the Mag 7, of these technology companies that have done so well until recently. Many of them have piled into the same securities. And so sometimes clients will think that they're diversified over a number of sub-managers, but those sub-managers may end up owning the same security, a lot of the same securities. And so we sometimes find with new clients that come to us that they really aren't aware of the fact that they, across these sub-managers, the sub-managers have ended owning a lot of those same stocks, and in particular, a lot of those same tech stocks. So they may end up with an over-concentration to technology stocks somewhat unwittingly.
Interesting. So the client thinks they're being diversified because their advisor is choosing 5, 6, 7, 8 different managers, but those managers are not speaking to each other. And so they may actually all be buying possibly the same thing, in which case the client wouldn't be aware of that. Wouldn't the advisor's job be to try to understand that and see if there's that duplication?
Absolutely. And one would hope that that's happening. But again, that's a lot to cover for an advisor if you've got hundreds or thousands of different clients. So that's, you see that happen unwittingly. And listen, it's even happening in S&P 500 index funds. A lot of people think by investing in S&P 500 index fund that they're broadly diversified. What they have sort of failed to notice is that the top 10 holdings in an S&P 500 index fund make up 35% of that index. And so again, heavy concentrations in those top 10 holdings. Over the last several years, the top 10 holdings have been largely tech focused. And there could be great reasons to own technology, but a lot of people are doing it unwittingly through the use of funds or sub-managers. So
yes, sometimes when people invest on their own, I'll hear them say, well, I just buy a S&P 500 index fund because then it's easy. I don't have to make any decisions. I really don't have to, peel back the layers and peel the onion, so to speak. But what they may not realize is that they think they're doing that to get diversity, but in fact, they're not.
Right. And there's a couple of key reasons why it's really important to be able to answer that question, what do I own? Right? Because if you can answer that question, then you can evaluate the risk of your portfolio. You can determine if your investments are aligned with your long-term goals and objectives. You can manage your taxes more efficiently. For example, if you get to the end of the year and you realize some of the stocks that you bought are at a loss, you can harvest those tax losses and use them against gains and with other holdings that you might have. And perhaps, I don't want to say most importantly, but pretty critically, you understand what your liquidity profile is, because some funds that one might invest in through a sub-manager or directly might be funds that are invested in alternatives. Again, a perfectly good asset class, but many times with alternatives, whether they're hedge funds or private equity funds, your capital is locked up. And in order to redeem those funds, you need to provide a certain amount of notice. And one of the things that we learned in 2008 as we had new clients come to us was many of them at that time hadn't realized how little access they had to their capital if they needed it quickly. And as the world was changing very dramatically at that time, many of them had underestimated their access to capital. So understanding your liquidity is really important too. And if you understand what you own, then you can evaluate your risk, determine the alignment of your objectives, manage your taxes, and understand what your liquidity profile is. And those are all really important things to to know as you embark on planning for yourself and other people or institutions that you care about.
Those are all great things that maybe people don't always think about when they think about their portfolio. Of course, when you're on the golf course or doing the cocktail chat, right? What does everybody care about is performance.
Right.
How important is performance, and how do you judge performance? What are some insights you can share from your perspective as to how to think about performance as a client?
Yeah, so at the end of the day, if you're paying a professional to manage money for you, you want them to perform well. You're paying them to provide that service. If you're doing it on your own, you also want it to perform well, right? Because if you're going to meet those long-term goals and objectives, you need your assets to do well over time. And particularly as we're living in a world where people are living a lot longer. So, we plan for our clients to live to at least 100. So performance matters. And a lot of times what I find when I talk to people is because they can't answer that question about what do I own as easily as they would like, they'll often say that they meet with their financial advisor once a year, twice a year, and they go over a big thick book at the meeting, and they kind of look at the bottom line and they say, is it up or is it down? And then at the back of their head, they say, I really wish I kind of did understand what I own better. But if it's up, it's okay, right? And if it's down, maybe I need to take this big fat book home and try to really figure out what I own so I can understand why it's down. And hopefully their advisor can do a good job explaining that to them. But, I think lots of times advisors assume that people really understand financial markets and financial acronyms and lingo, and people can be really smart, but that just may not be a vocabulary that they have. I know certainly for me, before I entered the financial services industry, I didn't have a broad understanding of a lot of the lingo that we use when we're talking amongst ourselves. And so performance is critical, and underperformance over a period of time can really add up as we live to 100 or maybe longer. The days of living to 65, retiring, collecting Social Security for 2 years, and then dying at 67 or 68, hopefully for most of us, those days are behind us. And we can look forward to a really wonderful, longer chapter, up to 100 or even over a little 100. So underperformance really matters. And one of the things that I find with performance is a lot of times people don't focus on a couple of key questions related to performance. So how is the performance being presented to you as a client? First of all, it's really important to understand the difference between gross of fee performance and net of fee performance.
Sure.
Again, there are lots of different fee models, and they can work for lots of different reasons. But always make sure to read that really tiny fine print that you see at the bottom of any page related to performance, because it will tell you a lot. It will tell you gross versus net performance. It will help you understand that how the performance is being presented to you, what the composite is that the firm is running to demonstrate what their performance is. Sometimes, funnily enough, a composite can be a really small number of accounts that are managed by that firm. So, and that doesn't mean it's a bad thing, but it's just a good thing to understand how that performance is calculated and what accounts are included in that composite that is presented for presentation materials. The other thing that's really important to think about is the benchmark or benchmarks that are listed next to your performance. So you might be really excited to see that you were up 15%, your portfolio was up 15% in a given year. And you might be really excited to see that compares very favorably to the benchmark that has been presented to you. But the benchmark that's been presented to you for comparison purposes may not necessarily be the benchmark that is as relevant to you. And so common benchmarks that we see are the S&P 500, sometimes the MSCI World, and sometimes one of the Russell indices, the Russell 1000 Value or the Russell 3000. It's a good idea to do a little digging on those different indexes and just understand them. so that as you're comparing your performance to that index, you can get a sense of whether or not you're really comparing apples to apples, or if it's more of an apples to oranges comparison.
So what would be an example of, an apples to apples versus an apples to oranges? Can you say, if I was looking at a report, can you give us a more specific example?
Yeah, so if you were invested largely with in a fund or with a firm that was focused on largely domestic equities, then you probably want to see the Russell 3000 as a benchmark. If you were invested with a global manager, you'd probably want to see the MSCI World listed as one of the benchmarks. And many times you'll see more than one benchmark listed, because that allows clients to kind of peg how their performance is doing against 2 or 3 different metrics: a fixed income one for their fixed income portion, maybe a global one for the global portion, and a broader US index for the domestic portion. And of course, the world we're living in today, it's pretty hard to say, there's lots of US companies that have a lot of global exposure. So I always like to see, maybe 2 different indices for the stock portion of a portfolio, just to help the client have some context.
Okay.
At our firm, we compare against the S&P 500 and the Russell 1000. That gives clients a little bit of additional context. One thing I do always caution people on is custom benchmarks. That sometimes you'll see this. It's 20% of the MSCI World and it's 30% the S&P 500, and they kind of get sliced and diced away. Those get really hard to understand, and so. Again, just would encourage people when they're meeting with an advisor to ask for some of those broader, more understandable indices to provide them with context. So caring about
see how your portfolio measures up to those, but having more than just one, so that you really have a better sense of what's possible and how you're truly doing. But again, not to get too into the weeds if it's customized, and also to take a step back, to make sure you understand what you're being shown. You and I are both big proponents of that, it's okay if you don't speak the lingo. It's not okay if you don't understand and you're not being helped, right? As you should be able to ask any stupid question in a financial services meeting, and the person should be able to explain to your satisfaction. Otherwise, you really need a new advisor.
Absolutely. And Erin, you and I've talked about this before. It's just really critically important that advisors of all types feel comfortable and welcome those questions. I know we do, and I know you do as well. So, and that's another great question when we're talking about understanding your finances. What fees are you paying? Plenty of clients can determine that they'd be happy to pay a 2 or 3% all-in fee if it's meeting their goals and objectives. But it's important to understand the components of that fee. And so again, back to that outsource model that I was talking about earlier, nothing wrong with that model, but you can understand that there would be multiple layers of fees potentially. Mm-hmm. So a fee charged by the manager that you've entrusted to develop this strategy for you, then fees charged at the sub-manager level, and then possibly fees charged by mutual funds or ETFs that are employed at the sub-manager level. So again, everyone has to make a living, so there's no issue there, but it's just having a good understanding for how those fees can all add up. And to the point that you raised, sometimes that's a lot more than people think. Right. They need to focus on what they're paying, that first level fee, that fee that they're paying their manager, but they may not be as focused on the fact that some of the underlying managers and some of the underlying funds will also have their own fees.
Right. That can be really hard for a consumer to understand. I know I've seen that with insurance products where you're paying an insurance premium and then the insurance company is deducting certain fees, but then maybe you have an index fund and there's certain fees related to that. And it can be hard to understand. And it is unfortunately sometimes in 4 or 5 point font all the way at the bottom of the page or buried at the back. Right. But it's such an important question. It's such an important question. I think, fundamentally, if you don't understand the fees that you're paying, then, it might be time to get a second opinion and ask another expert to try to help you understand what's happening there. But of course, I've definitely had clients say to me, well, I don't think I pay for that. And I said, well, do you think they're just doing it because they
Right.
like you? Or do you think that maybe
Right.
there's a fee you're just not seeing?
Right.
So,
And a lot of times, it's just a question of, as we were saying earlier, asking the question, what are the fees for the underlying managers, or what are the fees for that mutual fund? And people, a great advisor will answer those questions easily for you and be happy to do it. So.
right.
Yeah.
That makes sense.
Yeah.
And what about, tax losses, tax harvesting? How do you know if that's being done efficiently in your portfolio, or what questions can you ask to make sure that that balance is there?
Well, that really goes back, I think, to the importance of, if you can answer these three key questions: what do I own? What is my performance? What am I paying? Then you can really have a dialogue with your advisor, right? Instead of having your advisor sort of preach to you once a year, you can have a good back and forth dialogue, which I think is the goal for most of us, right? We're hiring, an expert to help us with this, but we want them to pick up the phone. We want the door to be open. We want to be able to ask our questions, no matter how silly we think they are, and have someone receptive on the other end of the line. So tax loss harvesting is really a great discussion to have with your advisor. I'm a little biased, at our firm, because we own individual stocks and bonds. It's a lot easier to have those discussions with our clients. We know exactly what we purchased the stock or bond for. We know what it's trading for. We could talk to them about the rest of their tax picture each year. And they may have assets managed elsewhere, or they may hold on to securities that they don't want managed, and just make sure that if they're taking gains elsewhere and we have some losses, we can take those to offset them. I think most fund managers certainly have that as an objective, but you have to remember, particularly as it relates to mutual funds, that as they get redemption requests, they have to fund them, right? And so you may, I think we've all probably been in this situation at least once in our lives, where we're holding a mutual fund at a loss compared to what we bought it for, but we get handed a gain at the end of the year because there were enough redemption requests that the manager had to meet, and he or she had to sell securities at a gain within the fund, and that gets distributed out to us. So it can be a little bit harder when you're not invested in individual securities, in my opinion, to manage tax loss harvesting. But it's certainly a great thing to have a discussion about with your advisor, and they should be in a position to help you navigate that.
Sure. And then that's another question to ask, of course, what am I paying, but also what is my net return? Is it tax efficient?
Right.
Because of course, especially in New York, we all are in a very high tax bracket, and we're always paying too much taxes, right? So anything we can do to make our taxes more efficient.
Right.
It's not as sexy as talking about performance, but it is certainly an important component of ending up with more.
And that, again, really add up over time. The big thing about investing, as we all know, is the compounding effect over time, right? This is one of the reasons that whenever I a young person that's starting out in life, and I just say, sock it away when you're young, because if you can compound that over, decades, it can have a meaningful impact for how you spend that kind of last quarter or third of your life, So I'm a big believer in, any of us who know young people embarking on life, that's a pearl of wisdom for them, Erin. So yes, maybe that's another podcast topic, is what to advise younger people as they're launching into the world. So
certainly, but putting it away, investing it, not just saving it, but investing it, not being afraid and getting started early. That's definitely a pearl of wisdom for anyone. But it's never too late to start, but sooner the better.
Absolutely.
So. Now, is there ever a time when it doesn't make sense to own individual stocks, when someone should be concerned about that?
I think if you don't have enough money to be diversified, owning individual stocks, then being diversified across a mutual fund can make a lot more sense. And for a lot of people, when they're sort of starting, back to these young people, they're starting their investment lives. They may not have enough money to invest across a broad, in our case, 30 different stocks and be diversified enough. But we're we really do believe in the power of those, in our case, those 30 stocks and knowing what you own. But yeah, diversification is important. But it's also important to remember that you don't want to be over diversified, because if you're not concentrating your capital behind your best ideas, then you can end up with kind of a muddled middle, I'll call it, okay-ish performance, but you can miss opportunities on the upside by not concentrating capital behind your best ideas. So, but yeah, certainly for people that are just starting off and may not have developed enough of a nest egg, mutual funds and ETFs can make a lot of sense. So, and listen, Erin, there are lots of great ways to manage money. I happen to really like the way that we do at Douglass Winthrop, but an informed consumer should go out and talk to a couple of different types of advisors and find the one that works best for them. As I said, I'm a little biased. I like knowing what I own. I like understanding the performance. I like understanding the fees. I like being able to have clients, open up their statements and recognize most of the names that they own, because they're household names. They might be companies that they do business with, and that's easy for them to understand. But there are lots of great managers out there, and the key thing is to find a manager that can answer these three big questions for you. And if you're satisfied with those answers, then you're an informed consumer. And as an informed consumer, you then can have that ongoing dialogue with your client, which is so important, and with your advisor, client advisor dialogue. It's so important because life changes. People die, people get divorced, people move states, people have kids, people start a business. Tax laws change. We certainly know that. And markets go up and down. And so establishing a relationship with an advisor where that dialogue, where that back and forth exists, as opposed to just that annual meeting once a year where maybe they sort of lecture you a bit and you listen. I think establishing that dialogue is the most critical thing of all. And being able to answer those three questions allows you to establish that kind of a dialogue with your advisor.
That's great. I find in my side of the business, there are so many times when people have a financial advisor, but they clearly don't truly have a relationship. They don't understand what they have. They ask questions, or maybe they don't ask questions. Maybe they just trudge through a meeting once a year and throw the packet in the file cabinet and ignore it.
Right.
Or maybe one spouse goes to the meeting and the other doesn't. They kind of know, oh, my portfolio's up, but they don't know anything else. So I think for anyone listening, what we both have seen is, really the key is to start by understanding what you have and by having a team that you're aligned with. And if you don't have that team, it's time to get another one.
And a team that communicates with each other, as you and I do with clients that we work on together. That's really critical too, because, we often see, I know you do as well, but the people's advice can be very siloed. They have a manager, they have an insurance specialist, they might have a trust and estates attorney or a CPA, but those people may not necessarily be talking to each other. And as you and I know, if those people aren't talking to each other, then a person's plan may not be optimal. Again, that goes back to dialogue among the advisors that work on that team. And that's another really important conversation that should be taking place on behalf of the shared client.
Sure. Having an advisor that wants to have that dialogue with your trust and estate attorney, with your accountant, with your insurance professional. I know we've seen clients come to you with insurance proposals that didn't make sense based on their budget. They made sense based on their net worth. They didn't make sense based on the fact that the husband was really unhealthy. The wife was super healthy. The wife really needed more in her bucket. And so, by having a conversation, understanding the clients, you and I know we can do a much better job. But for anyone listening as a client, I think that's often missed, is making sure that your advisors work as a team. So that is definitely a pearl of wisdom for anyone listening. You might like all your advisors, but how about getting them together and having them communicate? Things work much better when that happens.
They really, really do. And you and I both know that we've cleaned up a lot of situations where, that conversation hasn't taken place among advisors. And it's kind of interesting for you and me. We sort of enjoyed that challenge, but ideally clients wouldn't end up in that situation as often as they do.
Right, for sure. So to end, do you have a success story or a short example you'd like to share with the listeners today?
Yeah, so we've discussed a lot of what I consider to be success, right? But to me, one of the things that I love is when a client or a family or a trustees come to us, and which is often at a time of change or transition. Someone may have died, someone's gotten divorced, someone's disabled, someone's retired. The responsibilities has been passed from one generation to the next, and wanting a fresh look at fresh set of eyes looking at things. But to me, the great success story is to help people understand those questions that we just talked about, and to facilitate that dialogue with them, and to have the door be open for those kinds of questions, and to help facilitate the conversation with their other advisors. A plan is perfect for a moment in time, as we know. The legal documents can be signed, the portfolio can be invested, the insurance can be in place, but it's that brief moment. And so ongoing success to me is a continued dialogue with the client, and a continued dialogue with their other advisors, so that the plan remains relevant and consistent, and that the client can achieve their long-term goals. And I've had a number of clients that have come to us not being able to answer those three questions, and then we'll meet with them, and they feel that they really can answer those three questions. And a lot of clients have said, I just feel so grateful. I don't worry about this anymore because I understand it. So to me, that's actually the greatest success. I don't worry about it anymore because I understand it, and I trust the team that I've put in place. And if you could take a big stack of paper, or the digital version of that clients show up with when they're new clients, that they can't answer those three questions about, and make that stack a lot smaller and a lot easier to understand, and have them sleep well at night, then I feel pretty good about going home and sleeping well myself. So that's the success story, and the hope is that happens every day with clients that you and I and others get to work with.
I agree. My favorite compliment to get from a client is, wow, you explained that so clearly. I finally get it, or I understand. You see the light bulb go off, and I know I've done my job. If someone can understand something, especially if they maybe didn't understand it before, right?
You and I've discussed this before, Erin. And I would say, out of all the different subspecialties, I think most people would agree yours is the most complicated to understand. So that is
not easy.
It's an ongoing compliment to you that anyone who interacts with you really can understand that. So, including other professionals on the team like me.
Right. Yes, they should understand too, right? Sometimes they're a little more shy about asking the questions, but it is important. So, well, I think we've covered so many wonderful topics, and hopefully everybody listening has gotten some great advice. What is the pearl of wisdom? We've mentioned several, but what is the pearl of wisdom you'd like to leave our listeners with today to sum up our conversation?
Yeah. So I think the pearl of wisdom is be an informed consumer. Ask those three questions and feel comfortable with the answers, and keep on asking them until you feel comfortable. That's, if there's one thing that I would remind people, it's your money. And so you have every right to ask those questions, and to keep asking them until you get the answers that you need. And then if you're an empowered consumer, you, over the long run, can develop that plan and that long-term relationship with your advisor and team of advisors to meet your long-term goals and objectives. So that's my pearl of wisdom: be an informed consumer and keep on asking those questions until you get the answers.
Perfect. I love it. So anyone listening, you make sure you're asking your financial advisor, what do I own? What is the performance of my portfolio? What are the fees that I'm paying? Asking these questions and knowing the answers will help you be a better client, a better informed investor, And I'll add my pearl of wisdom to that to make sure that you have a great team and that you understand and are on the same page with the people that you're paying to advise you. So that's where that's what I would add.
Sounds good to me.
Perfect. Well, thank you so much for being my guest today, Lee. And thank you to everyone who is listening. I hope you enjoyed this episode, and please follow us for additional guests and more pearls of wisdom coming soon.
Thanks so much, Erin. It was great to be with you.
You've been listening to Financial Pearls of Wisdom with Erin Ardleigh. Erin is the founder of Dynama Insurance. For more information, visit dynamainsurance.com. That's DYNAMA insurance.com. This podcast provides inspiration and ideas. It is not to be considered legal or investment advice. It should not replace getting professional advice on your personal situation. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, and Spotify. Thank you for your positive reviews and for sharing this show with others.